just to give sort of a quick intro on to what we're going to be diving into for the next 20, 25 minutes. Obviously, the title is up there. But essentially, we've got three guys here who work in and work with a lot of CVCs who are navigating change at the moment. And just a sort of a few headline facts to begin with. Exit considerations are more pronounced in the market. We're seeing VC secondary market grow. We're also seeing secondary usage among CVCs grow, with 22% of funds having used them, up from 15% in 2024. That's quite a jump. And there were just sort of two stats there that obviously link to pressure on transitions in CVCs. Sadly, fund wind downs. We're seeing this, and we're going to talk about this in this session. We don't want to avoid that topic. But ultimately, we're still all here to try and buck that trend. And actually, what can we all do as an industry to help CVCs manage the portfolio transition? I think that's what we're going to talk a lot a bit on for now as well. So yeah, we're going to explore how units can navigate change over their life cycle. And this is due to shifts in corporate priorities, management, ownership structures, not necessarily new challenges in the world of CVC, but I think what we want to do in this session is actually look at the practicalities of actually what those outcomes then, what the outcomes that those lead to. So just to start with, gents, obviously I'd like you to introduce yourselves one by one, but after that introduction, just give us a general sort of bird's eye view of what you're seeing in the market right now in terms of the topics I've just mentioned, in terms of how tough it is around strategic change for CVCs, given what we're seeing in the market. We're seeing wind downs. Just to give sort of that perspective, and then we'll go into sort of more of the detailed topics to begin with. So, Martin, if I could start with you.
Sure. I mean, we all know that VC and as such also CVC has not seen its easiest times over the last, 5 years. DPI obviously is a huge topic in VC. Probably more than ever, we see funds after 10 or 12 years not even being able to show 1x DPI. I just spoke to a colleague before, and we discussed about the relevance of DPI for CVCs and agreed that, for CVCs, it's usually less important because the strategic aspect is on top of it. But nevertheless, we see a lot of movement in the market recently. Jim actually yesterday showed the statistics that I think there's a record number of CVCs at the moment. And I'd be interested to dive a bit deeper into that number to see, how many of those are actually, potentially zombie CVCs not investing anymore. Because what we see in reality, it started a few years ago in Switzerland. We had some of the larger CVCs, larger for Switzerland, we would say a few with maybe 100 million, 200 million assets, all of a sudden stopping and winding down. Then in Europe, we saw ING, we saw Munich Re, Commerzbank recently, and now in the US, you have Fidelity of PayPal, just to mention a few. And this has really come in a massive wave now to how I see it, and with different reasons, but I think that's unfortunately a fact.
Yeah. Pepe, if I can just turn to you, because Martin, you obviously you were intrigued to dive a bit deeper into some of those numbers around the amount of units there, and I know that a lot of the work you do is trying to change that average lifespan of a CVC, which is, alarmingly low.
For sure.
So maybe, turn to you next on what you're seeing generally.
Yeah, I see multiple close downs also. And that is also why I do what I do, right? And I run the EU VC corporate podcast as a main thing. The focus from my side is the lack of understanding from C-suite and, what is corporate venturing as a strategic tool. And I've previously highlighted and talked to, the people in this room, how do you do it? What it all comes back to is that there's no individual playbook for this. It comes back to culture. It is the culture of the given corporate that will be defining the success and how long time the CVC will live, and it's your job to understand that, right? There's nothing where you basically can lean back and say, okay, I need to drive for financial return because then I will be alive and the CFO will not kill me. But if you are not doing any strategic fit, then it's going to be the head of strategy or the CEO that's going to say, what are you doing, right? So it's kind of, you need to understand the culture of the corporate you work in.
Yeah, no, thank you. And then, David, turning to you, because just to comment on what Hervé just said, I mean, at our own events around the world, that point of culture, we have had big CEO names talk at our events, CEOs of big global brands, and they have spoken very positively about the CVC unit. But I feel as if that's, slight anomalies at times. I think there is an education piece as well that's been talked about in these last 2 days a lot on that. There are CEOs who believe in CVC and get it, but I think what we want to go on to next is actually maybe how we change, get more of them to do that from an educational piece, and also for the CVC unit to show resilience to the corporate board that sort of gives them that confidence. David, you work a lot on these topics, and you spoke to us on the briefing call a few days ago about future-looking resilient strategies for corporates. So maybe you want to sort of start with some.
Yeah, and my name's Danny. I'm a lawyer, so I'll try not to be too legally today. But my practice on the venture side is heavily CVC. And I should add, sort of for context, it's heavily life sciences, pharma, medtech. And I think the reason I highlight that is pharma, medtech, CVCs, I think, are, as a category, one of the most resilient, successful CVC categories. And I think the reason for that is illustrative for other CVCs, which is pharma and medtech are they're innovation-driven businesses, right? The nature of drugs coming off patent, royalty cliffs and so on mean that they're constantly having to reinvent themselves, and the culture of that is one of innovation. I'm not saying there aren't companies here that have innovation at their heart, but the economics of a pharma or medtech is that they have to keep creating new ideas, new assets, and there's a recognition that they can do great things internally, but sometimes you need to invest in partners to sort of build either the ecosystem or future M&A targets. And I think, sort of linking to your question, I think that's where other CVCs sometimes maybe go wrong, which is one CEO is really into venture investing, has a hobby horse, and it just sort of gets parked. And I think what you need to do is sort of articulate to the company, how is this future-proofing customer base, supply chain, M&A targets, whatever, new geographies, whatever it is, it can't be a purely financial instrument, I think, because ultimately when a new CEO comes in, investors look at the EBITDA numbers and profitability. A CVC, is typically always going to look like a negative compared to other bits of the business on a pure financial assessment. And so it's making that articulation of where the strategic gain is.
And I think what's interesting in that, right? What you work with is corporates that are used to working with a pipeline mentality, right? They know they need to put things in. They know something will fail, but the success is going to carry it, right? Yeah. So I think that mental preparation you can also start to give C-suite very early on.
I mean, Happy, we're going to comment in a few minutes actually because I know you wanted to give some example or your viewpoints on that. Old adage, strategic, financial, we'll come on to that a bit. But Martin, just back to you and actually leaning on from what David was saying about the success examples of pharma and life science companies. Martin, a lot of your work is around helping CVCs navigate changes, particularly their portfolios. Just before we go into actually sort of more of the positive thinking about what can we do to improve this, would you mind just maybe sharing some, obviously not maybe allowed to name specific names, but some of the reasons that you're seeing as to why, CVCs are struggling to navigate this change and actually why some of the examples you gave in your intro have occurred. David talked about certain sectors actually being good at this. Maybe if you just give some views on the reasons to why certain sectors aren't.
Sure. So I always try to understand why a CVC or why a corporate has decided to wind down its CVC unit, because we also want to help those CVC units we work with to become more resilient. Yeah. And I think I never get like a clear picture. There's not that one reason. Well, if I would name one reason, it's probably change of CEO. Yeah? Because when you have a new CEO coming in, that CEO obviously needs to change a few things. We've seen PayPal Ventures. They've had their third CEO in 3 years. So even though they were doing extremely well, they've been around for more than a decade, it finally hit them. Very unfortunate. And I think in the end, it's a puzzle. It's a puzzle of things, and there's not that one answer of one thing that you need to do right. So I think financial, I also had that discussion with the colleague before, and we were discussing, to what extent is it important that a CVC is financially successful. And in fact, we hear from many corporates when they discuss with us the setup of a new CVC unit, they say, returns don't matter to us. It doesn't move the needle. We don't care. We really want to make this successful from a strategic point of view. And we keep insisting and telling them, no, it is absolutely crucial to have financial returns, because strategic benefit will take time. And it cannot be a strategic goal to lose money. And you're just in a much better situation when on top of everything you can prove that you're making money. Then obviously there's the strategic part, which I would say is the most important one. And also when we as outsourced partner manage a CVC portfolio, we always insist that there are 1 or 2 persons on site of the premises, if possible, from the corporate, making the strategic bridge. And I mean also, going to lunch with the business leaders, being close to the strategy team, and that oftentimes doesn't happen. And if that is lacking, that oftentimes is the reason why a CVC shut down.
But I think there, Martin, one of the things you said when I had you on the podcast, right, and we discussed, when the decision was taken to do a wind down or a handover, you had one portfolio company that you were looking at, and you could explain to the executives that if they did a little bit more investing into this company, the financial outcome would be so much better, right? And I think that is super interesting. So when you get to that, they kind of understand it.
Well, I mean, it comes back to mindset, yeah? And mindset at the corporate level is, usually, when they decide to set up a new CVC, it must be there to a certain extent. Although I have never seen an executive board where everyone is like, yeah, we're doing a CVC, you always have, some in there who are criticizing it. Yeah. And that's the risk when you have changes in the C-level team. But once, and we had the situation, I can name it, with SCOR, the reinsurer, and the CVC team left. So, at that point in time, there was hardly any mindset left for what is VC about. And that was that example I think you referred to, where a portfolio company was relying completely on SCOR because they were the sole institutional investor. And, they obviously, when you want to wind down your CVC unit, you don't want to make further investments. Yeah. So we convinced them, look, they need a further runway. We will try to onboard new investors over the coming months, which we succeeded. And now the company is independent of SCOR, and SCOR by that was able to preserve, the value of their stake.
Going to come on to that in a bit, actually, how, tips for navigating secondary sales phase outs. But David, just quickly on this before we move on, Martin was quite strong about CEO change. I'm sure you probably agree, but is there any other factors that you've seen as to why this phase out wind down process has started? Because that might help us think about how we can.
Well, I think the thing that struck me when Martin was speaking was this discussion is focused on the CEO and the sort of great men or women of history theory, right? They're like, you have this person come in and change the board and everything. And I think successful CVCs touch all aspects of the business, right? Because the politics, I'm sure none of your corporates have politics, but let's imagine there is politics for a moment. It's very easy for the new CEO to come in or a rival on the board to go, well, this is rubbish, da-da-da-da. But if the CVC has bought in throughout the business, like, different sales teams, business development, whatever, and has become sticky within the organization, it's easier at a board level, I suspect, for the CVC to survive into role transitions rather than just being the pet project of a CEO that might get sacked after 5 years and all the rest of it. So I think it's that sort of stickiness throughout different bits of the business, and that leads to the strategic point, which is, are you showing actual strategic value? Like, are you creating companies that create more customers, create new markets, create new M&A target, whatever it may be? Do you have other backers within the business or just the CEO? Yeah.
Sticky CVCs, I think that's apt given the heat this week, isn't it? That's what we need more of. Great. Martin, any comments on what David just said to that point before we go?
Yeah, I can always go. I think it's so right what you're saying, right? There's all the right elements in there, because if you think you can run around in a corporate and hide and not be found, right? There is a budget that is running that CVC, right? And that will be cut if you do not have that sticky solution to what it is. So it is finding the small wins, right? Make sure you produce strategic insight that you can send through the organization, right? Yeah. Have that strategic head on, but be mindful you need to deliver returns, like Martin said before, right? Otherwise, it just doesn't work.
Well, let's maybe just quickly stay on that bit in terms of, David, your point of almost sort of disseminating into more of that corporate space, whether that's more cemented portfolio development teams that simply focus on portfolio development and not just investing, I mean, we had a session yesterday, a meeting where, quite on a granular level, there was a group of heads of CVCs who said we'd actually love, and I think we, GCV, might start looking at this, small training videos for CEOs and corporates just to explain what the CVC does, what it can do, but from quite an easily digestible point of view. I mean, I guess, would that be something you'd sort of suggest to try and start, or is there other resilience topics that we want to look at now?
I think it's a great idea. I wonder how it would be accepted and used. I mean, you know, when we work with CVC teams or new teams to set up a CVC, we always try to get access to the CEO, to the C-level, and we tell them, you know, it'd be great to have a session to, you know, you can't use the word teach, but to talk about VC and the mindset of VC to the corporate leaders. And I must admit, it has almost never, ever happened. And not because the CVC teams didn't want us to speak to the leaders, but because they just, you know, why would they speak? They just taken the decision to set up a CVC. They know what they're doing, and they have plenty of other stuff on their table. So I think it would be great.
So the work that you do with CVCs, are you primarily, you're just always dealing with that process doesn't start from someone from the corporate, does it? Or does it? Yeah. Okay.
But again, I come back to, I'm doing some training at the moment for a client where their CVC and their business development teams are completely separate. And CVCs sort of, you know, dance a bit of a fine line when you're investing in a company and the company's getting nervous of conflicts of interest. And you say, oh no, I'm an arm's length investor, but also I'm doing it for strategic reasons. Like there's that dance that everyone does. But I think bringing different bits of the business together in a training and that more junior level is a good idea, because back to my pharma's just quite easy as examples. It's very common in a pharma context, the CVC makes an equity or convertible debt investment, and the BD team then will do a license, collaboration, sort of early, you know, project with the company at the same time. And so you have two different teams who are bought into that asset. And I think there's no reason you can't do that in fintech or, you know, industrials or whatever, have like collaborations or sort of referrals or whatever, but then you're sort of building in more people, buying in more people within the organization.
But I think it makes sense, right? I think you need to find the way in your organization where the way you get heard. And whether that is through a weekly newsletter, a small podcast, inviting the corporate into a room like this auditorium and share whatever it is, it's a portfolio company presenting an exit, or is it an expert from the industry, right? You need to find your way and you need to share it. And I think actually those small videos make sense.
Okay, great. Conscious of time, but actually one thing I did want to get all three of your views on, and not to sort of leave some of the more sort of down conversations to the end, but, you know, I did want to talk about phase outs, wind downs, secondary sales, how that can actually be managed in an efficient way, Martin, to you, and then Hepe, actually, you know, some of your views on actually are there alternatives out there at the moment. So Martin, maybe we should start with you.
I mean, for a CVC team, it's always a shock when such a decision comes. It's oftentimes also a surprise. They oftentimes go their own way because they're, you know, not happy about not making new investments anymore, and they look for a new role in their career. Corporates, typically they want to sell the portfolio at NAV, and then they find out a few weeks or months into the process that they're only going to recover, you know, maybe 30% of the value. And that's where we basically give them the offer that we manage the portfolio on behalf of them. We take over the board seats. We get some powers of attorney to run it. We work a lot with the portfolio. We try to, you know, create value to bring in our vast network of co-investors. We have 200 portfolio companies within Redstone, so we have a big network, and to help those portfolio companies like that. And actually, you know, we also have situations where we lack resources when, you know, sometimes these things happen quickly also for us, or we lack, you know, the know-how about the specific vertical. And so sometimes we also take over the team, the CVC team that then joins Redstones, for instance, in the case of Helen, the energy provider in Finland. We have taken over 3 people from their venturing team. They're now part of Redstone. they do the phase out on behalf of Helen, but can continue to work on other topics, potentially, new funds that we set up in a regular GPLP.
And I guess everyone, what we're trying to look after is the portfolios, right? I mean, that at the end of the game, that's what CVCs go into. That's what they're set up for, is to care about the entrepreneurs, to help them grow. So I guess that needs to be, at the core of any strategic change.
Yeah, and the goal obviously is to have a better outcome than the corporate selling the portfolio at 70% discount. And so we look at every situation differently. We do secondaries in an upcoming round to have a deal sweetener for a primary investor. We sell to a co-investor who is interested to increase his stakes. There are many other options to create a substantially better outcome. Okay.
Just before I come to David, any thoughts from your response on this?
Well, no, I won't be legal when we're at time before lunch, because that's the last thing
anyone wants. I'm in charge, so we can go on.
Typically you can't actually just sell out, right, as everyone knows from these companies, and so some very sophisticated CVCs build that into their investment, but that's kind of hard to do later on. I think the best thing is patience and cope for a secondary, right, as Martin said, and that you sort of can sell your lower class at only a slight discount to the round price and so on. But I think it requires quite a high level of honesty, because any investor who sees a CVC selling out of a company in the sector is going to get really nervous, right? And so the people need to understand that you not only are you exiting, but you have to actually be quite open with everyone about your change in your corporate strategy, because the one thing a VC is going to hate is like, oh, well, why am I investing in this company when the main corporate in that sector is dumping the stocks, right? So I think that's a challenging point that sort of honesty has to come with it.
Yeah. Pepe?
No, I think there's so many reasons, right? And doing right or wrong in this situation is difficult. Now, my former colleagues at Maersk Growth is in this situation again, seeing what they can do about the situation. And again, you never know, but I think, as Martin pointed out before, when they realize the cut they need to take, because they're in that, right? The first, they're thinking about, what is our brand going to suffer from this close down? Is it going to be severe? And then secondly, when they have fired everybody, can they recoup money, right? So I think it lies somewhere in between there.
Okay. I know we've talked a bit about resilience topics. We're at a CVC conference, so I'd like to sort of have the last section about, hopefully avoiding, some of the examples we've seen. I know that these are some areas that, some of you guys don't work in, but would love to get each of your views on, right now, what would you love to see as a resilience topic that more CVCs are taking up? Not because they're not, but just from the examples that you've seen, and suggest to the audience to try and actually become more sticky, to David's point. I mean, David, maybe we start with you. If you want to maybe dive a bit deeper in some of those sort of life science examples that might help.
I think the CVC can be important as identifying new opportunities, because one thing most large corporates, if I may say, are not typically known because you reach a certain side and innovation is not the name of the game, and new ideas. And I like the newsletter idea and videos and so on. I think it's about bringing founders in, showing partnerships, showing collaborations, even if it's sort of sandboxy to the previous panel ideas, is getting the business, the big corporate excited about new ideas that are out there in their sector, which people who've been in a big corporate for a long time, some people get stuck in their lane, some people don't, but some people in corporates get a particular way of seeing the world. And so the more you can do to use the portfolio as an internal marketing campaign and come up with projects for collaboration, I think is helpful.
I agree. I agree. And coming back to the puzzle pieces I mentioned before, I think this is the most critical one. Financial return is an important one, but also stay close to your sponsors. Make sure you always have, preferably not one, but maybe two people within the executive board that you can keep close. Maybe they're on your investment committee, maybe in another way. And the last bit we didn't talk about yet is structure, obviously. Yeah. So if you just have an annual budget, which may vary from year to year, that's obviously the worst, starting point. Then you can have usually you have just a fixed committed amount, maybe in a separate legal entity. Maybe you have an LPGP structure, which still is not so resilient if it's a single LP. The ultimate way would be to have a multi-LP structure, maybe two, not competitors, but two players from the same industry joining forces, which also make it more difficult.
And you've seen examples that support that sort of
I'm still looking for examples.
No, I think the best that I've seen during the past year is actually Mark Thom that sits down here from Henkel. I think when you study corporate venturing and understand how to do it and create the playbook, Mark has created a playbook for everything. It is written down. The stakeholders know what is expected in a given situation. So when you start up a new CVC, just learn, go out and study and learn from the best. And I think, the high financial performance will also come from the planning, right? So if you plan from a strategic level, you will also get the financial performance. And then, of course, Mark is a superstar. So
Well, no, thank you, because I've got here, I know you wanted to share a narrative on, your financial capitalist view, but also your strategic rationale.
Yeah, I think it's, it's a schizophrenic job to be a head of CVC, right? Because internally you are a strategic investor, but you also know you're a little bit of financial, right? So you're a strategic financial investor. But if you run around in venture capital ecosystem and say you're a strategic investor, the room is empty. You have no co-investors, right? So you have to have that schizophrenic in VC life, you are a financial strategic investor. Yeah. And I think for me that is so essential to understand that you can address the stakeholders that you are fronting at every given point of time.
Before I ask each of you just for a very short, snappy, final, bold statement on this general topic, do we have any questions from the audience on No, just wanted to
We answered everything, and that's clear.
Yeah. Okay, gents, 30 seconds, final statements on, navigating change. Martin?
Well, I think just every single day, not every single day, but every once in a while, think about what you can do to make your CVCs more resilient. Never, as you mentioned, never lean back. Things can change quickly when you have a change in leadership. Think about what could be the potential next step to make it your organization within the corporate more resilient. Recently, we worked with a client, and they wanted to set up an LPGP structure, single LP, with the goal to ultimately have a multi-LP structure. The board declined, but agreed that, after they had a long discussion about CVC, agreed, this is very important for us, and agreed to double the committed amount. So that was a positive outcome, step by step.
Great. Pepe?
Get the governance right from the beginning, right? Just go down. If you don't have it now, go home and draft it.
Good. David?
I think you need to give people a reason to support you. So your portfolio companies, you need to show them some strategic gain of having a problematic strategic investor on their cap table, and you need to show internal people what the business is getting. And I think always coming back to how are you achieving the two different sort of masters you've got.
Great. Well, Pepe, thank you for joining us. I know I came to your event last year, so thank you for, and Martin, David should have mentioned that their organisations have also been sponsors of this event this week, and we hosted a dinner on Monday. So thank you to both of you as well. Thank you.
Thank you.